Under the Companies Act 2014, there are 4 different categories of companies in Ireland, and each of these categories have different kind of responsibilities when it comes to reporting and different kind of legal obligations as well. And these 4 categories are micro, small, medium and large. And in this video I'm going to go through exactly what those reporting obligations are for each of these different categories and how you know which category your company actually falls into. And it is important that you actually understand these, or at least your accountant does, so you make sure that you are not, say, over-reporting or else in breach of the Companies Act. Here are the thresholds that we use to assign all of the different individual companies to each different category. So there are 3 different kind of criteria. If your company is above any 2 of them, then you move into the next section from either small, medium, up to large. So a micro company is any company that has a turnover of less than €900,000, has a balance sheet size of less than 450k. So when I say balance sheet size, that is the total assets. So your current assets plus your non-current assets, and has less than 10 employees. Once your company is under 2 of those thresholds, it will be a micro company. These thresholds have only been increased recently. So for a small company, then you have all the way up to 15 million in turnover, balance sheet size of 7.5, and employees of up to 50. If you breach more than 2 of those thresholds, then you are going to be moving up to the medium size, which is anywhere up to 50 million in turnover, balance sheet size of 25 million, and up to 250 employees. And then finally, once you breach the medium size threshold, you will become obviously a large company. So now let's actually go through the different responsibilities and different kind of quirks that you need to be aware of for each different category, from micro all the way up to large, because there is a fairly big difference in what you need to report to the likes of the CRO and your responsibilities when it comes to either the company being audited or not. So firstly, a micro company. So a micro company can prepare fairly simplified financial statements under a reporting standard called FRS 105, and I'll show you an example of one of these financial statements in a moment. And the information that you actually share with the CRO and upload every year, it's quite limited, so the public can only see a very limited view of what's actually going on in your company. And another great thing about being a micro company is that you don't have to have your financial statements audited. So you can avail of the small company audit exemption. And that would basically mean it'll be much simpler and cheaper to meet your reporting obligations. But it's important to be aware of as well that you cannot really be late when it comes to submitting your accounts with the CRO. If you are actually late, you can lose that audit exemption for 2 years, and the cost will significantly increase for you if you have to get your financial statements audited. So just to show you a random example of micro company financial statement, which I have downloaded from the CRO. This is a plumbing and heating company here, and this is the contents of the financial statements. There's just a brief director's responsibility statement. That's just kind of a standard statement that needs to be included in the financial statements, and then they only share the company's balance sheet and notes to the financial statements. So you'll see that in here they don't share the company's profit and loss, so you won't be able to go in and see this company's what they've made in terms of their revenue for the year. So that is one big advantage of being a micro company, that you only have to share your kind of balance sheet. You don't have to share a detailed breakdown of your company's profit and loss, showing, say, the revenue and your cost of sales and your expenses. There will, however, be one note included in the notes to the financial statements showing just a movement of your profit and loss from one year to the next. I'll show you what that looks like in a moment. So here is the director's responsibility statement, just a standard kind of wording here that the directors need to sign off on. The company balance sheet then just shows the summary then of the company's fixed assets, current liabilities, and its equity. Then we move on then to the notes, and the notes are quite limited for a micro company. As you'll see here, it's just a standard in terms of their turnover, their basis of preparation, which was FRS 105, as we went through there, and different policies around, say, their depreciation policy, how they value their stock, their borrowing costs, how they recognize government grants and stuff like that. And then here is the note on the appropriation of the profit and loss account. It will just show one single number of the profit and loss of the company during the year, and not a full breakdown of its revenue and expenses as well. So as you can see, it's nice being a micro company in terms of the reporting obligations. Now let's have a look at the next size, which is moving from micro to small. Now the difference between a micro sized company and a small company is not very much, in that they have to do their financial reporting under FRS 102 section 1A, which is just slightly more detailed than the FRS 105, which we saw previously. Both small companies and micro companies can be eligible for the audit exemption, so you don't have to have your financial statements audited. And again, if they are late with their submissions to the CRO, they may lose their audit exemption for 2 years. So that's just something definitely to be aware of if you are a small size company. You can also file abridged financial statements with the CRO. So when I'm saying abridged, that means you don't have to again submit your profit and loss account as part of, say, your financial statements. You'll only have the balance sheet again and a couple of notes, but the notes would probably be more detailed under FRS 102 section 1A versus the FRS 105 for micro companies. So let's have a look at another example. Under FRS 102 section 1A, the only difference in the contents page here is that we have more information about the company in terms of who the directors are, the secretary, who their bankers are, who their accountants are. We also have a statement of changes in equity, which is kind of a reconciliation of the movements of any profit and loss, and also if there has been any kind of issuances of shares in the year, you can see that in the statement of changes in equity. Other than that, it's pretty much the same as FRS 105 for micro companies. So here is the information that you have to submit in terms of the company's registration number, the accountants, the bankers, solicitors, and then the statement of directors' responsibilities is basically the same again as FRS 105. The balance sheet here as well, is quite similar in what you need to report. There's a bit more detail that goes into the line items on the balance sheet that you need to report under FRS 102 section 1A. Versus you can have a more summarized version in FRS 105. Then we come down to the statement of changes in equity. As I was saying here, this shows just a movement from year to year in terms of the shares that the company issues and also the profit or loss that the company is making. And then in the notes to the financial statements, as you'll see in the last set we had a look at, there was only literally 4 notes, a couple of policies, and the approval of the financial statements and the appropriation of the profit and loss account. But as you'll see here, we're going from 4 notes all the way up to, how many notes have we here in this set? There's actually 17 notes in this set of financial statements. So you have to disclose a lot more in terms of the supporting information between all those line items on your balance sheet. They'll have to pretty much have a note there supporting and explaining what's behind those numbers. And then lastly, let's have a look at how the reporting obligations significantly increase when you move to being a medium and large size company. So the reporting framework that you need to prepare your financial statements under will be FRS 102. And as you'll see in a minute, there's much more detailed information provided for in the accounts that you must submit with the CRO, so that will be publicly available for anybody to download. And generally speaking as well, the financial statements must be audited unless there are some specific circumstances that allow you to get an exemption, but in most cases they will be audited. And the financial statements that you submit with the CRO, you don't get the advantage of a micro or small company where they get to submit abridged financial statements. You have to submit your very full set of financial statements to the CRO to be published on their website. So let's have a look at an example of what that looks like now. This catering company here now is preparing financial statements under full FRS 102. As you can see here, they submit their full company information similar to the small company, such as the company registration number, directors, the auditor, the bankers, solicitors. And on the contents page, as you notice here, there's much more involved here. They also have to include their director's report in the financial statements. They have to include the auditor's report. They have to include their statement of comprehensive income, which is essentially their profit and loss account. They also have to have a cash flow statement and a full set of notes supporting all of that information. So it's much more involved, and there's much more work involved in preparing this set of financial statements, which must be submitted. The director's report will have certain sections on it that are kind of required to be submitted, such as the principal risks that the business faces, the principal activity that the actual business carries out. They need to kind of have a summary of what that is. If there's been any dividends paid out to the shareholders, any appointments or resignations for the directors, any interest that the directors or the secretary have in the shares of the company. So if they own shares in the company itself, you'll need to detail that in a disclosure note in the director's report as well. And then after that, we have the director's responsibility statement, which is similar to what we've seen previously. Then we have the independent auditor's report. So this will be the report that is prepared by the auditor. And in this auditor's report as well, the auditor will give their opinion on whether the financial statements give a true and fair view of the assets, liabilities, and financial position of the company as at the reporting period. Generally speaking, you're hoping to see that there's an unmodified opinion there, that the auditors are happy that the financial statements are relatively not materially kind of misstated. Then you're moving on to the next section here, which is going to be the company's comprehensive income statement. So as we saw for the micro and the small companies, they didn't have to include this in their financial statements at all. That the ones that are submitted anyway to the CRO. So here in this case, we can actually see the company's turnover. We can see their gross profit margin. We can see their admin expenses. We can see how much tax they're paying, and we can see their overall profit. So the information that we can see here is much more detailed, and we can see as well the company's balance sheet, similar to previously. Then along with the statement and changes in equity, we also have a cash flow statement. So you can see the movement in terms of the investment that they have made, say in different, say tangible fixed assets or any other kind of investments that they've made, taxes they've paid, and their working capital needs. That will all be included in the statement of cash flows. And then there will be a much more detailed breakdown of notes supporting the information in the profit and loss account and the balance sheet, etc. So they have notes covering all of the different companies' policies and kind of a breakdown of the different line items on each of the profit and loss. So like they have a turnover note here, for example. They have a note breaking down their salary costs and their director's remuneration, the taxation, and they also have notes there for the tangible assets, the stocks, the debtors. So kind of each line item is almost broken down with a note with further information. So as you can see, if we compare from the start from a micro company all the way up to a large company, a micro company, you get away with submitting not very much information at all. Your company is not audited. Whereas for larger companies, you have to submit much more detailed information with your financial statements that are shared publicly, and also your company needs to be audited. So that was just a high level summary of all of the different categories of companies that exist under the Companies Act 2014 in Ireland. And you can see with these thresholds where your company fits in, and then based on that, you'll know what your obligations are in terms of whether you need to be audited or not, and the level of detail and the financial reporting framework that you need to use when preparing your financial statements. So I hope that all made sense. If you have any kind of questions about what I went through in the video, leave me know down in the comments. One thing I didn't really cover in the video was groups, and I might do that in a separate video just to not confuse things.